So core discussion here is that a company's values are referred to as the carrying value of assets. The tax base, on the other hand, is the tax authority's values. Now, IS 12 makes a fundamental assumption that any change in the value of assets or liabilities
So, Brian, did you solve the question or want to do this first before going back to the question?
is the same thing. We're working on the question.
Said?
It's the same IS 12. We're just reviewing
Okay.
IS 12. So it makes a fundamental assumption that any changes in the values of assets or liabilities in a company would lead to a tax consequence or will lead to tax consequences. That's the primary discussion, and that's why we have all these discussions that we're going to have in terms of deferred tax and all that affects that recognition of deferred tax. Now, where the difference is as a result of timing, then IS 12 basically requires that, or IS 12 describes this as a temporary difference, and that temporary difference will ultimately have tax consequences. So we said that where the timing difference will lead to future tax obligations, this is referred to as a taxable temporary difference. On the other hand, where the timing difference will lead to tax benefits or reduction in future tax remittances, then the temporary difference is referred to as a deductible temporary difference. Now, we went on to say that for assets, and we discussed this, assets greater than, the carrying value for asset greater than the tax base implies a taxable temporary difference, and the opposite is the case. So if the carrying value is less than the tax base, then we have a deductible temporary difference, and that deductible temporary difference times the tax rate gives you a deferred tax asset. And so we went and said the exact case is the same for liabilities. However, we also looked at how we account for taxes with the income tax expense charged to profit or loss, then the tax estimate based on actuarial assumptions by the company goes to the current liability, and then it's the deferred tax computation based on actuarial assumptions. So that's basically what we discussed. Now, in this question, there's a discussion at the base of the question where it's talking about, in the last annual meeting, how one of the shareholders questioned deferred tax, the recognition of, and the discussions around deferred tax to the company's executives, and the shareholder said he didn't understand the concept of deferred tax and did not understand why accounting standards make adjustment to tax that do not reflect actual amounts of tax paid. And that's the truth. Deferred tax doesn't reflect the actual amount of tax paid. Instead, it allows an entity to make provisions for taxes when there is a change in asset or liability. Now, this is kind of funny if we think about the definition of assets or liabilities. And maybe that's where we start the first question, because if I remember well, the question asks that in response to the shareholder statement regarding the concept of deferred tax, discuss the conceptual basis for recognition of deferred taxation using the temporary difference approach to deferred taxation. So we're going to discuss this now and look for those 7 marks. So I go back to our question. We'll just set up and work on question. How is it spelled again? Kesare. Okay, is our Excel showing?
Yes, yes.
Okay, all right. So. So all the whole of the question, what I think is useful is that all the question is all on taxes. So it's usually good when we have a question that can help us just get a hang of things, and both discursive and computational.
Yeah.
So I think for 7 marks, there are a number of things I want to think about. So we'll just do as usual. So our A now. So look at the A part. And it says, in response to the shareholder statement regarding the concept of deferred tax, discuss the conceptual basis for the recognition of deferred taxation using the temporary difference approach to deferred taxation. And 7 marks. So what you're trying to do is get 7 points that are reasonable in discussing this. And there are a number of things that start flying to the fore. Now, we start with the shareholders' assertions that so the conceptual basis, okay. So what did the shareholder say? What did the shareholder say? The shareholder raised the question regarding deferred tax to the company's executives. The shareholder stated that he did not understand the concept of deferred tax. Is the second question now, let me be sure. So the second question talked about the difficulty. Okay. So he said, the shareholder stated that he did not understand the concept of deferred tax and did not understand why accounting standards make adjustment for tax that do not reflect the actual amount of tax paid. So the shareholders' assertions that IS 12 makes adjustment for tax for taxes that do not reflect the actual tax paid is true. And that's one of the easiest things I've done in recent times in answering a question. I respond to what he said. It's true. It's true. And that's important. Now, let's break this down and give ourselves understanding of our discussion. Why do we say it's true? Now, the first point is, as usual, maybe we'll just come back once it logs us out, and we work on that question for the second part of the class. So for anybody that's okay, I don't think there is. Judith, are you there?
Yes.
Okay. All right. Have you seen the question we're working on?
Yes.
Okay, so it will log us out now, and when we come back, we'll discuss, or we'll take the steps through what